The next paper is written by Alex Edwards, Michelle Hutchins, and Ann Person, and it's titled, "Do Third-Party Cross-Border Tax Transparency Requirements Impact Firm Behavior?" And Alex is the presenting author. And so Alex, we see your slides and you look like you're ready to go. You have 20 minutes. The discussant will be Elisa Kasi from NHH. She will have 10 minutes after Alex is finished. Alex, take it away.
I was all ready, but I forgot to unmute before sharing, and then I couldn't find the unmute button. Okay, well, yes, thank you. Well, thanks for the introduction, Pete, and thank you to all the organizers for the invitation and opportunity to present. This is a relatively new paper, and so we're excited to get the feedback. And a thanks in advance to Elisa, who we were very excited to see as our discussant. We use DAX 6 as the setting here, and Elisa has a number of papers on that subject. And so your comments are, I'm sure, going to be helpful to us. As Pete mentioned, this is co-authored work with Michelle Hutchins at the University of Illinois Urbana-Champaign, and Ann Persons as well, who's also at Illinois. And I believe Michelle is joining us this morning or this evening or whatever the case may be for you. So the motivation for this study, or I should first mention that for those who don't know what DAX 6 is, it's a new transparency requirement where the primary reporting burden is put not on the firm itself, but on preparers. So we're looking in the same sort of very broad area as Scott is. So I actually could use Scott's first couple slides as my motivation as well. There's been a lot of tension about aggressive tax planning, particularly around cross borders and for multinationals. This is something I think academics have been talking about for a while. It's been in the business press, and then even in the last 5-10 years has cropped its way into the popular press. And so, for those of us who socialize with non-academics and you say you're a tax researcher, the reaction maybe isn't as visceral as it once was, and people actually have something to say, not always well informed, but at least something to say about tax behavior, which is nice. So numerous initiatives have been undertaken to try and combat this kind of behavior. Scott mentioned the OECD BEPS project, which has had lots of recommendations. Individual countries have undertaken various initiatives trying to target broad tax avoidance or some specific types of transactions. Joe Biden, in his Made in America tax plan, attempts to target some of this behavior through a global minimum tax of 15% on book income. So all aimed at trying to reduce cross-border income shifting or cross-border tax avoidance. Some of these initiatives include transparency requirements where the taxpayer themselves needs to report information or disclose information about transactions they are undertaking or the structure of their firm. But as far as we know, up until DAX 6, this was the first time where that reporting requirement fell not on the firm itself, but on a third party. And in this case, the third party falls on intermediaries, things like accounting firms, law firms, various consultants. So the big picture research question we're looking at here is, do these third party tax transparency requirements affect tax avoidance and income shifting? So just a little bit more about the setting for those who may not be as familiar with it. So DAX 6, the DAC part stands for Directive on Administrative Cooperation. So this is an European Commission directive from 2018. And it had three main features around the tax reporting regime. So it covered a broad set of potential arrangements. They refer to these as hallmarks. There's an appendix in the paper that lists these out. It has early reporting. The companies, or the advisors, I should say, need to begin reporting on these as early as implementation. So it's not just when it's actually showing up in income. It could be even sooner. And they include an automatic information exchange among EU member states. So just in pictures, because I find pictures easier to follow sometimes. So if we've got a taxpayer that's in an EU country, and they're engaging in some sort of reportable transaction, and that transaction involved an intermediary. So this would be like the accounting firm advising the taxpayer. So the advice flows from the accounting firm to the taxpayer, but at the same time, the advisor's also got to report to the tax authority in that EU member state. And then when that happens, information gets exchanged from that tax authority to other EU tax authorities where this taxpayer may have related parties that it's transacting with. And so we've got other regimes, and in most reporting, we're just on this side here. We've got the taxpayer reporting to the tax authority, sometimes with sharing, but the new piece here is bringing in these advisors. And so I've mentioned there's a few pieces to this. In the paper, we really focus on this third party piece for a couple reasons. One, it's the novel setting here, but two, we also think this is the real teeth of this regulation. And so consistent with this, one of my co-authors was at a recent American Bar Association meeting and attended a panel on US European tax trends. And there's a lot of discussion about DAC 6, and one of the panelists referred to this third party reporting requirement as using a sledgehammer to crack a nut. I think universally the panelists thought it was sort of an undue burden on the preparers, sort of regulatory overreach, all that sort of stuff. So they seemed quite concerned about it. I presented this paper a couple times. Oh, before we get to that. I presented this paper a couple times to North American audiences, and sometimes even some of the tax people in the audience hadn't heard of DAC 6 and kind of questioned, was this really that big of a deal? I'd imagine, although I'm sure you'll let me know later, that this is probably not so much the case with a European audience, that you're more familiar with this regulation. But just to give a measure of kind of the salience of this, we've compared in terms of just Google search volume, a fairly crude measure, but I think it's useful for kind of how much people are thinking about this or wanting to learn about this. So we've compared the search volume traffic for DAC 6, presented here in orange, with country by country reporting, just another relatively large tax standard that you might be familiar with. And although there's more searching normalized at the highest at 100% around country by country reporting, we do see about half that volume of people searching for DAC 6 or related terms, which I got listed down there. Okay, so stepping back, thinking a little more kind of big picture. So what are the objectives of a reporting regime, a mandatory tax reporting regime? So when tax authorities require firms to report additional information, what are they hoping to accomplish with this? So there's two main things. So the first is a deterrence effect. So just the fact that you're required to report increases the cost of you engaging in some form of tax avoidance. You're going to have to let the tax authorities know about that. And the hope is that you think about that increased cost, and that's going to deter you on the margin from engaging in some of this behavior. Assuming you actually go ahead with the transaction, in addition to the deterrence effect, there's a transparency effect, that you're providing the tax authorities with information about what you're doing. And this lets the tax authorities better target their audits, more efficiently allocate resources, sort of gets to the meat of the issues with a specific taxpayer, or even the selection of taxpayers to audit to a lot faster. So how does this specific reporting regime come in, the DAC 6 third-party advisor reporting? Well, on the deterrence side, the transferring the primary responsibility of reporting to that third party puts a new cost on a new party that's involved with these transactions. And so now the advisor themselves needs to report. If they don't report, there's potential penalties. And so you're deterring not just the taxpayer potentially from engaging in them, but you're deterring even the advisor from potentially advising, marketing, consulting on these type of transactions. So you're increasing the deterrence by adding this other party. And I should note here that the requirements are such that if there's not an advisor, or if the advisor doesn't report on it for some reason, the taxpayer themselves is then supposed to report. So it's not just you get out of reporting on these if you don't have that advisor. You do still need to report. On the transparency inside, this is less about the third party part, but the transparency on these is a little earlier in the process than some other transactions or some other reporting regimes. And so it provides more timely information to the tax authorities to help with activities. So if I've done my job so far, I've probably convinced you this is important. This will deter companies. This will make things more transparent, make audits easier. So why wouldn't we observe an effect here? In related or somewhat similar transactions, like the country by country reporting regime, there's been mixed evidence of how much deterrence that actually has. And so if you look at these studies, one of these is on banking firms, one more broadly, they find evidence of decreases in effective tax rates, but not necessarily evidence of decreases in income shifting when they try and use those tests to zero in a little more. So I know lots of discussion about how draconian and invasion of proprietary information and all that sort of thing that country by country reporting was, but at least empirically, the evidence wasn't that strong of an effect. There's also the possibility of a crowding out effect, firms over-reporting on these. So every possible transaction that could fall under the hallmarks, throw it in the disclosure and overwhelm the tax authorities with information. So you want to know what aggressive cross-border transactions we're engaging in. Here's a list of hundreds, and you pick and choose which ones are the important ones. So the hiding in plain sight argument. So because of these arguments on both sides, we make our first hypothesis that the third-party reporting requirements, the information exchanges on these cross-border arrangements will result in multinational entities reducing their effective tax planning. Later, we're going to look at the effect on their use of advisors, but I'll come back to that hypothesis. I think I'm still doing good for time. So how do we test this? We use a difference in difference research design to pre-post the effective date for DAC 6. So our treatment firms are multinationals with operations in a European Union country. Control firms, we do, I'll say 2.5, or we do 2 and then combine those for a third control group. So one control group. Other multinational entities that do not have operations in the EU, domestic only firms, and then combine all those and run it all together. Our sample period, we look at 2015 to 2019. That was the most recent data available when we were running this back in the fall. And our event date, our pre-post date, is the effective date of DAC 6, which was in June of 2018. So this wasn't the first reporting date. This was the transactions as of this date would need to be reported. And so most reporting, it varied by countries, but didn't start for some time after that. We look at 3 different outcomes. 2 are heavily related. So first we look kind of at broad tax avoidance measures, effective tax rates adjusted for the statutory rates for both the book rate and the cash rate. And then we drill down on the specific type of behavior targeted by the standard income shifting. And our sample, we have about 83,000 firm year observations, representing around 20,000 unique firms. These are the parent or the headquarter locations for these companies. So you'll see the darker the yellow, the more of the sample that's in these countries. So lots of yellow in Europe, although there is a bit of a concentration of US parents, Chinese parents, and Japanese parents, although nothing is more than just over 15% of the sample. Looking at the parallel trends before and after the event. So this is just an estimate of the gap ETR. So before, not significantly different than zero. After our event in the middle of 2018, we see a significant increase. On the cash ETR side, similar pattern, although you'll notice bigger confidence intervals here. So just not significant in 2018, but lower, and then a bump up post the effective date. In a multivariate setting, so here our dependent variable is first the gap ETR on the full sample, so both control groups lumped in. We have a treatment indicator, post indicator, and on the interaction of those two, we get about a 1.5% higher effective tax rate following the implementation date. Comparing it just to multinationals that are non-EU, or comparing it just to domestic firms, similar point estimates. These models, we have year, industry, and country fixed effects, and then we also have a fairly standard set of control variables you see in ETR models. So I've got the full table here, which might be a little too small to see depending on the size of your screen, but the usual suspects are all there. Cash ETR, similar results, slightly larger point estimates, although slightly larger standard errors. So the estimated effects around 2.5%, about a percentage point higher, but a little bit lower significance levels. But together, relatively strong and consistent evidence that there's an increase in ETRs following the effective date for the affected firms. We then look to the income shifting tests. And here we use Huizinga, Levine, Cobb Douglas production function type model, where we have profits on the left-hand side, the tax incentive to shift at the subsidiary level. Observations are now at the subsidiary level. We've jumped up here, and it's treated and post indicator. And so on the three-way interaction there, we get significantly higher profits in the treated firms in the post period. So an evidence consistent with a reduction in income shifting for those firms. There's the full model if you're interested. We do a couple cross-sectional tests, or actually split sample tests, to look at places where we think the effect should be stronger as confirmatory evidence. So one thing some of you might be thinking is, well, if the advisor's a lawyer, lawyers are relationships with lawyers are privileged, and so lawyers don't necessarily need to disclose information they've heard from the taxpayer. And actually, some countries, as they implemented tax sticks, extended that privilege to non-lawyer advisors as well. And so in those countries where privilege has been extended, we expect the regulation to have less teeth, because it's more difficult to require the advisors to actually report on these. And so we split the sample with extended privilege, non-extended privilege, and we see a significant result for the extended privilege, but not where they, where the extended privilege was not granted, but no effect where it was. The penalties also vary by country. So it's a EU regulation, but implemented at the country level. Some of the countries have quite low penalties for non-reporting. Others can be quite high, some over 100,000 euros. So we look at that as our cutoff. So we sort of say high penalties is a penalty of more than 100,000 euros. We actually observe an effect in all countries, or at least both groups, but the effect is significantly larger in the high penalty groups. So I think I've covered the takeaways. As I mentioned before, we also look at the use of third-party advisors. So ideally, we'd have a list of what consultants, advisors, accountants, lawyers are being used. Unfortunately, we don't have that information. The best we could come up with at this point is we do have the amount of tax fees being paid to auditors. So we're going to look at the use of the auditors for tax services as well. So it's an argument for a reduction in use. I think that one's pretty intuitive. There's this reporting requirement on the third-party advisor, so you might just use the third-party advisor less, so they don't have to report on those transactions. The advisors themselves might sell fewer tax planning schemes. There might be an increase in use if you're going to kind of try and plan around some of these rules. So you might modify or implement different transactions. We look at the use of as well as the fees. Fees might go up because of the advisors trying to compensate themselves for the increased risks they're now facing because of their reporting requirements. So we make our hypothesis there in the null. There won't be a change in the advisor use. What we observe is, so here's a model with a 1-0 whether you use your auditor for tax services, and we observe a significant decrease in the post period. So you seem to use your auditor less often for tax services. But looking at fees, we look at fee increases and decreases separately, but don't observe any significant change. So overall, we find this DAC 6 reporting regime increases the reporting requirements, specifically on the third-party advisors, and that leads to a reduction in overall tax avoidance measured by ETRs, as well as the specific type of tax avoidance targeted, income shifting. Firms are less likely to use their auditor for tax services. So evidence fairly consistent with this regulation having the intended effect. So thank you, and I look forward to Elisa's comments.
Thanks, Alex. So Elisa Kasi is next, and she will discuss. She has 10 minutes.
Good morning, good afternoon, everyone. From my side also, it's a great pleasure to have read this paper and discuss this paper. As Alice said, I'm also working together with the industry, so I have some joint projects on the AC6, but there is still a lot I learned from this paper, so it was really interesting to read. And just to recap very shortly, so the paper is about this new directive of the European Union, which, so the paper empirically examined the effect of mandating the reporting of potentially aggressive cross-border tax arrangement when one of the innovation is that the primary duty is on the intermediary. And the authors look at two main aspects. So they look at whether it change tax behavior, they look at tax avoidance, and finally, actually the introduction of the AC6 lead to a higher cash and book ATR and a decline of income shifting for the treated firms. And on the other side, they also look at external advisory use, and they find that treated firms after the introduction of the AC6 are less likely to use the auditor for tax service, but they don't find a change in the tax fee to the auditors. And my comments are mainly on three areas, and then I have some minor ones. So the first one on the relevance of the research question. As I said, I find the setting very interesting, and I think that it's very important to look at the tax transparency initiative, because we saw a lot of them in the last decades, and there are discussions for further development in tax transparency area. So I think it's very important to have empirical evidence on whether this initiative actually worked, so whether they were effective in the policy goals of reducing tax avoidance and evasion. And I think that even in the introduction, the paper could even motivate more why these results are so relevant. On one side, because they are super timely. There could be like really some concrete example of country to make the point that it's not just a European thing. For example, Mexico already recently introduced also its own DAC6. And as far as I know, Norway has a discussion on the table on whether also to introduce such a regulation. So I think these are important to highlight that the results are very important to know, because it could help country to decide, do we also want such regulation or not? And also, I think it could be interesting to highlight how costly are such regulations. So, of course, on DAC6, we don't have yet an evaluation of the cost of this initiative, but the European Commission issue an evaluation of the first. So DAC6, as also Alex said, is a part of this directive on administrative cooperation. This is the 6th amendment, and there is an evaluation of the first 3 in this area, and it has been a huge cost for tax authorities in Europe. So again, it's very important to know whether there's been benefit of it, did they work? And the second set of comments I have, it's actually my biggest comments is about the contribution. And I think already the authors make a strong contribution, because they are the first to document empirically whether DAC6 led to a change in tax behavior and the use of external advisory. But I think a stronger contribution could even be made whether there could be the possibility to really disentangle what makes DAC6 work. Because yes, on one side, the innovation is this primary duty of the intermediary. The intermediary is set a very broad sense, because also, for example, multinational, the tax unit could be considered an intermediary. And so on one side, yes, it is this innovation, but on the other side, the policymaking in Europe, the huge discussion was also about the relevance of the information themselves. So the idea of the European Union was really to have this timely information about cross-border arrangement in order to make more effective tax audits, and also to address policy changes. So which tax system need to be changed and improved. And so I think this paper could try to look at, does it matter the fact that in this case, DAC6 is about third-party reporting, or does it matter about this new information set? And for example, I thought it's similar to country-by-country reporting. In the sense is the idea to get a better picture of cross-border activity of corporation. On the other side, it reminds me also of the tax transparency initiative in the individuals field, so on tackling cross-border tax evasion on individuals. So for example, the model we have on automatic exchange of information, the US model, FATCA, and the CRS, whether there's been also in that case, the primary duty is the intermediary who has to report the information. And if on one side, on country-by-country reporting, the evidence are mixed, on the other side, on individuals, we actually have already evidence that in that case, we had a strong reaction of tax evaders. And so I was thinking that actually the test you are doing on the legal professional privilege is telling already something about it, because it seems to make it matters who is reporting the information. You show that the country that decided to have a restricted rules, so where it is even more that really tax avoider has to provide this information, the effect is stronger, actually is driving the effect. And in that case, the legal professional privilege, it doesn't change the content of the information. The information that needs to be reported is the same, but it matters, so it changes who has to report it. And I was thinking that a further evidence or further interesting text would be to look at the subsidiary auditor. It's available at the Orbis, as far as I saw, because as far as I know from the industry, there is this reputational damage coming on, because for example, Big Four has this, are afraid that this information could also be leaked. And in this case, if it's in the domain of the public, could be also misunderstood, because the DAC6, so which transaction needs to be reported is very broad, is extremely broad. And there are a lot of transactions that are really daily business, so nothing to do with tax avoidance. And so there is really this threat of this information going to the public, which might affect. So for example, I was thinking if the subsidiary has a Big Four or like the larger auditor who might have this reputational threat going on, they might react stronger. So it could be interesting to look at that. And finally, my set of comments are more on the additional tests. So specifically robustness check on Portugal, Poland, Ireland, and UK, because the law covers also, in that case, cover also domestic transaction. So I think it would be useful to have a robustness check without those countries. And similarly, Ireland, Portugal, and UK, they had similar regulation before 2018. It was not that extensive as DSC6, but still there could be that they biased the results. So I was thinking of also in that case would be valuable potentially to exclude those countries from the analysis, or even use those countries to exploit the fact that they introduced it at a different time and use a setting of a staggered introduction. And finally, as an additional test, I was thinking also about the change in the tax department relevance. So there is this recent paper, each and co-authors looking at the relevance of the tax department and looking at Bordex data. And it would be much interesting in the set of results that you have on use of external advisory also to look at, does the tax director become more important, especially on potentially European Union headquarter firms that are more affected by this directive? Do they rely potentially less on external advisor and become the tax advisor part of the C-suite level, so the top executive level? And then, as I said, I have minor comments, but I will share those comments with the authors, so I think I prefer to leave the floor to the open discussion. Thanks.
Thank you, Elisa. Great discussion. So if folks have questions, comments, you can feel free to use the chat box or the raise hand feature. Max has raised his hand, so I will let him kick off the first question.
Yeah, thanks, Alex, for an interesting paper. I was wondering whether you could extend your contribution and also link your paper more to the literature on third-party reporting in the individual sphere. Because when I read third-party reporting, the first thing I thought about is this large literature that shows that individuals, if they have third parties reporting on their income, have very limited possibilities to evade or avoid taxes. And I guess the policymakers had something similar in mind when they introduced third-party reporting for companies on these transactions. Because I guess before it was like that a part of these transactions were disclosed by the companies already. Now there's a third party that reports on it. That gives you a new dynamic. For that, I think we need to know a little bit more about what is reported, how is it reported, and who reports. And so Lisa said that it can be the tax department as well as an intermediary. So if that's the case, it's more inside the company, or is it really someone outside? When I looked at DAX 6, I found loads of companies offering some kind of automated services where you could kind of automatically detect transactions. And that would point much more to this being something similar to what we have in the individual sphere, right? Where some automatic third-party reporting basically takes away some of the discretionary possibility of companies to disclose these transactions.
Thanks. No, those are great suggestions. I think, linking it back to the individuals and requirements for third-party reporting, that's a very intuitive link, and we should have that there. I think as tax accountants, our minds go first to corporate and maybe stick too much with corporate, but we can go on. This, sort of who reports is playing out in practice is being seen now, but at least the requirement is on these advisors first. But if there's no advisor, or if the advisor is exempt for something like privilege, then it can fall on the firm themselves. And so that's why I think some of these services, like you're mentioning, are being marketed to both the firms themselves. And this is where it gets confusing, referring to companies as firms, and the audit and law firms as well, for are they reporting what they need to on their clients. So great suggestions. Thanks, Max.
We have another raised hand, so we'll do Christina next.
Awesome. Well, I thought this paper was super interesting. It kind of made me think of FATCA, like how they all of a sudden made, they exposed or made the external party be the one who's having to report this. So I thought just a couple of comments. I thought, a really big benefit of this study versus other studies that I've seen that are kind of looking at things like this is you're using both CompuStat North America and CompuStat Global. I think a lot of papers just either use US data or they kind of focus on European data. So I think you're kind of underselling that, because it just, you're using like a, broad sample of home countries. So it kind of limits, problems with like the Tax Cuts and Jobs Act, which affected US firms and things like that. So I would definitely play that up more. Now there's a trade-off when you start using CompuStat Global, the data can get kind of messy. So I found in my own research that like cash taxes paid reporting in CompuStat Global can be kind of wonky. I know your results are robust to GAAP ETRs as well, but I would just look into that and just make sure that that's really what you want to use. And if not, then think about using current taxes paid as a substitute for cash taxes in some of the tests there. And just a couple of thoughts for cross-sectional tests that I thought would be super interesting. Since you have this rich data, I was thinking it could be interesting to look at, the home country and variation in that. So like the legal environment or the, corruption in the home country, and see if, if your results kind of weaken when you see those types of countries. Because there's been some prior research showing that, there can be, misbehavior associated with, firms that are, that are based or in countries such as those. And also, firms that have a lot of tax haven subsidiaries, or even you have a lot of firms that have tax haven parents in your sample, and kind of seeing how the results go within those firms. Is it weaker or stronger? Are these firms more likely to kind of decrease their tax avoidance and tax aggressiveness, or are they just going to keep on kind of going with what they're going with already? So anyway, super interesting idea. Just a couple of thoughts to help move the paper forward.
Thanks. No, great suggestions. Yeah, I've got a couple projects now using the CompuStat global data, and the taxes paid stuff is annoying. I'll put it that way. So you'll see, I think our sample drops by about a quarter here, but there's some other things around the data. I think we mentioned some in the paper and maybe need to do more. And thanks for the suggestions on some cross-sectional cuts. That's kind of the stage of the project I think we're at, is starting to think of how we should slice the data and what else we can learn. And those are all helpful.
Thanks, Christina. Sebastian also has his hand up, so we'll go to you next.
Thanks. So very interesting paper. I had a question in general about effect sizes and how you might frame those relative to other findings on methods of curbing tax avoidance. More specifically, and I know you didn't have much time to touch on this in the presentation, but I was curious about the results, which seem to show a big reduction in reliance on paying for these tax services without a concurrent reduction in the amount of fees that these preparers are charging. That struck me as a bit of an oddity, and I wondered if you had sort of thoughts on how to reconcile that. And on a very kind of narrow point, empirical point or econometric point, I was curious to what extent your results would change if you had firm fixed effects as opposed to these relatively broader country industry year fixed effects, since it seems like the data would allow you to at least check that.
Yeah, we'd love to do more with the use of advisors. We are limited to just the auditors, which I think in itself makes it difficult, because you don't know if they're substituting away from the auditor to some other party, or if the auditor is representative of what they're doing elsewhere. And then reconciling I mean, big is a relative term. I'm not sure how big the drop in use is to the change in fees or lack thereof. This is the last thing we added to the paper. Michelle, I know, was smiling as you were saying that. I think how we're calculating those changes, we might actually lose somewhere where there's zeros. Anyway, I'm going to make a note and come back to that. And I've already forgotten the second thing you said.
It was just a comment about fixed effects.
Oh, fixed effects. At the firm level as opposed to the industry, say. Yeah, we can think about that. We have roughly 4 OBS per firm, which isn't a huge number. And I'm not sure what the split is pre-post. So I'll look at the data maybe we can do that. I'm not positive.
Thanks, Alex. We have some comments here in the chat box. First from Tobias. He's wondering whether you could gauge capital market reactions around the announcement dates of the DAX 6 directive, just to look at kind of what investors perceive as the implementation costs, and perhaps looking at, I guess, some specific announcement dates to maybe disentangle the DAX 6 effects from other maybe policy effects.
Okay, we haven't looked at that. You know, it's an early draft, and I think we're already over 30 pages of text, so we're gonna have to make some decisions about what to add and what to remove. But looking at the capital market response is a good suggestion, and zeroing in on some of those dates. So thank you, Tobias.
Okay, another comment from Steve. So a criticism of the U.S. reportable transaction regime is that it captures legal transactions, but it looks like U.S. ETRs seem to have continued to decline after those rules. And his impression is that DAX 6 is actually broader, so capturing a broader set of legal transactions, but is effective at limiting avoidance. So he's trying to reconcile this. Is Europe just potentially more aggressive at pursuing tax strategies? Maybe there's higher reputational risk to the advisor rather than the firm. What about compliance costs? Is this actually inefficient in that firms are now losing access to valid tax planning?
So I think the big difference, or at least the difference we think is the important one, and anecdotally we've heard from advisors and preparers, is this imposition of the burden on the third party that doesn't exist with the US one. You know, that there's an argument that sort of, if you're cheating on your taxes, why wouldn't you also report on cheating on the, why wouldn't you also cheat on the reporting of your taxes? But this is now putting that burden on I'll say quote unquote independent outside party who may have higher reputation costs than you do in this sphere. The second part of that was inefficiency. I have no comment on whether this is efficient or not, other than to say from the tax authority's point of view, it does seem to have curbed some of the behavior, at least in the short run, that we look at. I'll leave efficiency to the economists on this one.
Great, thanks. Looks like we are, oh, wait, I think we have another question here. From Ben Oswald. Just providing some comments here in terms of survey evidence that corporate governance in European multinationals seems to be an important factor in the tax aggressiveness decisions. Maybe you could use those for cross-sectional tests to investigate responses to DAX 6.
Yeah, not something we've done yet, but it seems like that's a suggestion that makes sense. We'll see if we can get the data.
Great. So we'll save this chat for the authors. And of course, this is being recorded, so you can always come back and revisit the questions as well. But thanks so much to Alex, Michelle, and An for your nice paper, and to Elisa for your nice discussion, and to everybody for your questions. So we're actually running right on time, which